Hey everybody, welcome to Trading Capital's exclusive analysis. This is just a little bit of an analysis ahead of the FOMC meeting, which we get on Wednesday. We also have Apple earnings later in the week, but we have a whole host of economic data from JOLTS to job loss claims to more unemployment data. So the labor market data, the employment data is going to hit us fast and furious starting tomorrow with the JOLTS data. Now definitely pay attention to the JOLTS data, because if the employment data starts coming in better than the market is expecting, that's where you're going to see the yields rise. And that's kind of what we got a glimpse of today. If you look at the 2-year yield, we saw a glimpse of the 2-year yield surging and trying to recapture the daily 200 moving average. If I throw on the daily 200 moving average, you can see the 2-year yield closed right above that key level, which is a pretty important psychological bull market trend that often algorithms switch to and start buying or selling their bonds to buy the treasury yields. Now, if you look at the QQQ, what transpired today is you tried having a breakout, an official breakout on the daily, and it got rejected off of that level. And I found it extremely interesting to see that the Qs could not break out today, despite one of the bigger stocks in the Qs, NVDA, up over 4.18%. It's very rare that the Qs don't fulfill their upside target and actually close negative when the NVIDIA's up over 4%. And it just shows you how much selling was actually transpiring under the QQQ hood. And one thing I want you to pay attention to on NVIDIA now is NVIDIA just hit the most expensive it has ever been on a price to earnings multiple. It hit over 166 PE. And look at this beautiful trend line connecting your COVID low to your 2 pivot bounce here, your breakdown zone, and you officially tag that level, and it just so happens to coincide with this high pivot attempt at a breakout, reversal, failure, back lower. So definitely keep your eye on NVIDIA, because the fact that the Qs couldn't even close positive when NVIDIA was up over 4% is a little bit of a warning sign. It either means the market is lagging and NVIDIA is leading, or it means that NVIDIA is going to see a near-term reversal like the rest of the mega cap stocks in today's price action. One thing, paying attention to the S&P 500. I've been prepping my members about this key technical level, and it's a simple trend line that you have to watch. Connecting your major COVID low, connecting your major pivot low in June, and take a look at this level that we just tagged and bounced off of, and you've got a beautiful little reversal. You're missing the volume, being the fact that it's only 61 million shares, but it's a reversal nonetheless, and it's right off that COVID trend line. And it's also, the spiders had an attempt at a breakout today, and it got rejected off of that level. So what this tells us is there are sellers lurking here. Now, tomorrow we also get AMD earnings. That is going to be super, super intriguing tomorrow, because it's going to either make or break some of the rest of the semis. AMD has certainly been lagging NVIDIA, so maybe it starts to catch up. But then again, if AMD misses and it breaks this trend line, then you could be triggering a potential head and shoulders formation. This right shoulder hasn't really developed as much as you would like to see, but definitely pay attention to that, because what I'm noticing in some of the tech space here, and obviously AMD Semiconductor is a little bit of different, but when you look at some of the leaders like ANET, ANET has actually been the best performing stock in the whole XLK ETF in terms of the year-to-date and 1-year performance. ANET has been the best performing stock other than NVIDIA in terms of the year-to-date performance. And look at this rally that it's had since basically January. The lows was right around here. It's just had a magnificent rally all the way up about 47% year-to-date. So it's had a stellar rally. It's had a technical breakout. You've got a nice consolidation pullback. But if I flip to the after hours, this stock is getting clobbered in the earnings. So are we now at a turning point where, even though it's a double beat on earnings, are we in a turning point where the markets start pricing in a recession, where the leading stocks that managed to just keep rallying and defying odds are now starting to see some downside? Another one too is Stryker, SYK Corporation. So they're also gapping down. This has been a true market leader. You can see this new all-time high all the way up at this 306 level, and you're setting new 52-week highs just a few days ago. Look at this rally. You know, from November low over here all the way up, that's a massive rally in SYK. We're talking about just since the start of the year, I'll do a little bit of a measurement here. We're talking about a 23% rally, 25% rally, and then look at the after hours. Boom, big gap down, double beat. So notice the trend. Even though companies are beating and double beating, maybe we're at an inflection point now where the market really doesn't care what the earnings are. Maybe the multiples are too expensive in terms of the GDP now trading at 1%. Maybe the multiples are too expensive because interest rates are about to surge and trend high. There's a lot of different reasons, but I think it's interesting to pay attention to the fact that these two companies are definitely leading stocks. Even another one I bring to your attention, the healthcare space, just to get away from the tech. So Vertex Pharmaceuticals has been setting new 52-week highs pretty much every single time it rallies to the upside. And it's been a powerhouse stock just chugging along. Look at this rally. And then in the after hours today, they actually missed their earnings. They reported worse earnings, missed it by about 10%, and it is going to gap lower tomorrow. So I'm noticing that 3 leading stocks today have all gapped lower in the after hours off of their earnings report. Maybe it's just a coincidence, but maybe we are at a point where companies, no matter what they're going to do, or I shouldn't say no matter what they're going to do, but maybe as long as the earnings don't get blown out of the ballpark here, we're going to see some weakness and sell-off and profit-taking ahead of the Federal Reserve. And I think that's pretty prudent considering how we're stuck at resistance, considering the VIX is trading pretty much near the lows, and considering that the yields are trying to break out. It's very, very intriguing to notice. And then one thing I want you to pay attention to is oil was under pressure today. It did have a good bounce off the lows, but oil is looking like it wants to trend a little bit lower. You're putting in this consolidation inside of this breakdown bar over here, and this likely is going to send you to about $69.75. So $69.75 is the next technical level I have for oil. It's just a simple green bar breakout over here. If we take a look at natural gas was also clobbered today, but really nothing wrong with natural gas. This is putting in a basing formation. I am seeing intraday accumulation. Yes, there's still a lot of downward pressure in the energy market, natural gas, but I do think natural gas is coiling to make another big directional move to the upside. And this is the type of pattern you want to see. You want to see a move up, sideways chop, another move up, sideways chop, another move up, because what that tells me is that people who believe and have high conviction in natural gas trending higher are likely not going to get shaken out when we just have a 10%, 20% move up. There's, I think, a lot of long-term holders are starting to accumulate in this vicinity, and we are on the near cusp of breaking out of this potential wedge pattern from the low. There's still a chance that it goes to 221. I'm actually looking to accumulate a little bit more via the UNG if we flush down to this gap fill. But at this point in time, I'm long UNG, but definitely have some adding to do to accumulate a bigger and full position in the natural gas space. So really to sum things up, heading into the Fed meeting, I'm going to give some resistance, I'm going to give some support levels. So in terms of resistance levels, if we were to basically have a pop off of Powell, maybe Powell's a little bit more dovish and he comes out and surprises the market. 421.92 technical gap fill on the spiders is where I see my max target. That would imply from current levels about a 1.3% move to the upside. Now I do have some downward levels that if we were to flush on the Powell meeting, the level that I'm looking for is if you just draw your trend line from your high, you can see that we've bounced off of it once. That may provide a little bit of an intraday bounce, but the bigger level that I'm actually watching on the SPY is a retrace back to this inverse head and shoulders. This is going to be the bigger level. Maybe it'll coincide with this 200, but a pierce of the 400 level would be the level to buy for a potential long if we were to flush. And I mean, obviously the upside range is a lot smaller than the downside range. That's because we've had a tremendous rally for basically the start of this year. And the markets really need to consolidate still to move a little bit higher in the near term. But on that note, I think the overall expectation is Powell's set to raise rates by quarter basis point. That's already baked into the market price action. If he were to come up and do a 50, which I don't think is likely, that's certainly not baked in. You would see a bigger sell-off. But the real question is, what are his comments around inflation? What are his comments around the labor market? And what are his comments around the banking issues? I think it's pretty incredible to see how weak these regional banks are. Obviously, We all know that First Republic is no longer. They have been undertaken by JP Morgan Chase. So those 83 regional banks across America are going to be now known as JP Morgan Chase. But look at this reversal in the KRE. It just can't hold any gains. And then even the financials, the bigger financials, the XLF, went negative today when it was up quite substantially. So it really seems to think only a handful of banks are benefiting from this overall regional collapse, and JP Morgan up over 2.14% is certainly one that is benefiting. But then you look at Bank of America reversing from the highs, showing incredible weakness. The largest super regional bank, PNC, getting clobbered today. So there's still a lot of risk in this banking sector. If you look on the larger term time frame, PNC is putting in this wonderful bearish consolidation to move lower to my target 1 and then maybe target 2. But needless to say, banks are not looking positive here. They're not looking really that intriguing on the long basis, although there's still some of them are oversold. You just have to look at the larger term time frame patterns, and they are not looking bullish from my point of view. And I definitely think that this banking crisis is not over. I think we're going to see more. I don't think that the major banks can save all. I know the major banks can't save all of the regional banks. So at some point, a lot of these banks are not going to be undertaken. They're not going to be bought out. They're going to just let them fail, and that could lead to bigger deflationary moves to the downside. On that note, I'm going to recommend that we just be patient with natural gas. That's certainly how I'm playing it, at least. I think that this is definitely going to be at the $3 mark before we know it. I think we're going to blink, and natural gas is going to be back to $3 as gap fill before we know it. But at this point in time, all I'm seeing is a little bit of a bullish pattern on the daily. Accumulation is occurring for a bigger explosive move to the upside. Thank you all for tuning in. Please give this video a big like down below. Subscribe to the YouTube channel for all the latest video and insights, and definitely be ready for PAL. I think obviously they say the first move is often the wrong one, so maybe we see a pop and then a drop, maybe we see a drop and then a pop, but know that the technical levels, buying into support and shorting into resistance, is probably the best playbook. But when you look at some of these stocks, even for say Apple for a multi-trillion-dollar market cap, for Apple to rally just in 1 year, basically starting from down here, Apple has rallied over 36% in 1 year. There's going to be profit taking, whether it's the Fed that induces profit taking by being more hawkish, or whether it's just the market dynamics. At some point in time, these stocks are going to see some profit taking. And for a multi-trillion-dollar company to rally 36%, and we still have the majority of the year left, and if someone thinks that this Apple company can replicate another 10, 20, 30% on top of what it's already done, you've probably got you're going to have a little bit of a news flash and rude awakening, because multi-trillion-dollar companies need time, they need earnings to work itself through, and they need consolidation. These big sharp moves up, sharp moves down, sharp moves up are notorious for being in a bear market. In a bull market, you don't see this whippy price action. You see more of a trend pattern holding along the 200, a little bit of sell-offs that occur, but typically these big moves to the upside, big moves to the downside are notorious for bear markets, and I still think we're in a bear market. The spiders haven't really shown me the conclusive evidence that we're breaking out. And then really the bigger level on the spiders, the RSP, the relative S&P 500 equal weight index, that is showing some weakness. The RSP ETF is getting rejected off of a clear trend line today, down-sloping trend line, and this just means all of the stocks are equal weight in the indices. So if the indices is very skewed because of Microsoft, because of Google, because of Apple, because of Amazon, because of Meta, because of NVDA, and when you put them all at equal weight, it gives you a little bit more of a clearer picture as to what is happening underneath the hood of this market. And just pay attention, because like I said, when you see some of these leading stocks like ANET finally losing steam and gapping lower, like Vertex Pharmaceuticals finally losing steam and falling lower, and then you see Stryker, SYK, also gapping lower, that's a little bit of a red flag, because these stocks were the leading stocks of this whole 2023 rally, and when the leading stocks start to lag, that's when you got to pay attention to this market, because the market could be telling us and signaling us something coming in the near term. Thank you all for tuning in. We'll see you on the charts tomorrow.